Bernie Madoff was once the most trusted and admired figure on Wall Street, with a bulletproof reputation. But behind his respected image, he was running a massive Ponzi scheme that would eventually collapse, leaving thousands of victims in its wake. This man was behind the largest financial fraud in history. The way he was caught will honestly blow your mind and make you question if you can ever trust anybody again. This is the story of Bernie Madoff, a tale of lies, betrayal, and the ultimate downfall. Chapter 1. The Rise of Bernie Madoff. Imagine a world where everyone believes in the magic of investing money and making millions in return, without losing a dime. This was the world Bernie Madoff created. Madoff was born in 1938 in Queens, New York. In 1960, he started his own trading firm, Bernard L. Madoff Investment Securities, LLC, with just $5,000 that he earned working as a lifeguard and installing sprinklers. He quickly gained a reputation for delivering consistent, high returns to his clients. In the 1980s and 1990s, Madoff became a big name in the financial world. He wasn't just a successful businessman, but also a pioneer in electronic trading. His firm became one of the largest market makers on Wall Street, meaning it helped facilitate the buying and selling of stocks. Madoff's success and charm made him a trusted figure in the financial community, attracting investments from wealthy individuals, charities, and big investors. But behind the scenes, Madoff was running a Ponzi scheme, a type of fraud where returns to earlier investors are paid from the capital of newer investors rather than from profit. This scheme requires a constant influx of new money to keep it going, and Madoff was able to maintain this illusion for decades. Chapter 2. The Illusion of Success. Madoff's operation seemed flawless. He promised steady, reliable returns, even when the market was unpredictable. Investors were thrilled with their consistent profits, and word of Madoff's genius spread quickly. His clients included not only wealthy individuals, but also banks, hedge funds, and other financial institutions. To keep the scheme running, Madoff used his charm and reputation to attract more and more investors. His firm appeared to be highly selective, creating a sense of exclusivity that made people even more eager to invest. Madoff's strategies seemed too good to be true, but his track record of consistent returns silenced any doubts. The returns Madoff promised were incredibly appealing. While the stock market fluctuated, Madoff's investments seemed immune to downturns. Investors were happy and kept pouring more money into his firm. Little did they know their returns were simply being paid out from the new money coming in. Madoff also built a web of trust among his clients. Many investors were referred by friends or family who had already seen great returns. This word-of-mouth marketing was powerful, as people trusted recommendations from those they knew personally. Madoff's client base grew steadily, with more people eager to hand over their savings, believing they were making a wise investment. Chapter 3. The Cracks Begin to Show. As time went on, some people started to question Madoff's incredible success. Financial analysts and journalists couldn't understand how he managed to provide such steady returns, regardless of market conditions. Rumors began to circulate, and a few skeptics started to dig deeper into Madoff's operation. One of the first to raise red flags was financial analyst Harry Markopoulos. In 1999, he carried out an analysis of Madoff's returns and found that they were mathematically impossible. Markopoulos reported his findings to the Securities and Exchange Commission, SEC, but his warnings were ignored. The SEC carried out several investigations into Madoff's firm over the years, but failed to actually find the fraud. Even though he was being investigated, Madoff still carried on with his scheme. He was so confident in his ability to outsmart regulators and keep the illusion alive. He reassured his clients and kept attracting new investors, using their money to pay the returns he had promised. Madoff was also very secretive about his investment strategy. He claimed to use a split-strike conversion strategy, but he never fully explained how it worked. This secrecy added to his mystery and expertise, making it difficult for anyone to challenge him. Even when he was asked directly, Madoff would give vague answers or change the subject, maintaining control over his narrative. Chapter 4. The Collapse. The tipping point came in 2008 during the global financial crisis. As markets crashed and investors scrambled to withdraw their money, Madoff's scheme began to unravel. He could no longer find enough new investors to pay the returns he had promised, and the house of cards started to fall apart. In December 2008, Madoff confessed to his sons, Mark and Andrew, that his investment firm was a giant Ponzi scheme. They reported him to the authorities, and on December 11, 2008, Madoff was arrested by the FBI. The news shocked the financial world, and the extent of the fraud soon became clear. Madoff's scam had swindled investors out of an estimated $65 billion, making it the largest Ponzi scheme in history. Chapter 5. The Fallout. The fallout from Madoff's collapse was massive. Thousands of people lost their life savings, and many charities that had invested with him had to close or cut back on their activities. Investors lost billions of dollars, and the trust in the financial system was destroyed. The scandal also had a huge impact on the accounting profession. The Securities and Exchange Commission, SEC, faced harsh criticism for failing to detect the fraud despite multiple warnings. The agency underwent major reforms to improve its oversight and prevent such a massive failure from happening again. The legal consequences for Madoff were severe. In 2009, Madoff was sentenced to 150 years in prison, the maximum allowed. He expressed remorse for his actions, but the damage had already been done. His family was also deeply affected. His son Mark committed suicide in 2010, unable to cope with the shame and guilt. Andrew died of cancer in 2014, and Madoff's wife Ruth became a pariah, shunned by society. Chapter 6. The Reforms. The Madoff scandal led to widespread calls for reform. In response, the US government introduced stricter regulations to protect investors and improve the transparency and accountability of financial institutions. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010, aimed to prevent future financial crises and improve consumer protection. One big change was the establishment of the Consumer Financial Protection Bureau, CFPB, to oversee financial products and services. The SEC also increased its focus on detecting and preventing fraud, implementing new rules to improve the accuracy and reliability of financial disclosures. The Madoff scandal highlighted the importance of due diligence and skepticism in investing. Investors learned the hard way that if something seems too good to be true, it probably is. The scandal became a case study in business schools and a cautionary tale for financial professionals. The story of Bernie Madoff is a dramatic reminder that no one is above the law. Despite his reputation and influence, Madoff was brought down by his own greed, deceit, and his own son's shame. His actions caused immense harm to countless people, including his own family, and shattered the trust in the financial system. Here's the biggest takeaway from Madoff's story. Remember to always do research and do your own due diligence before trusting anybody with your money. There's always a chance you could lose all your money when you invest, so you need to make sure that you're prepared for that. If anybody promises you otherwise, it's a huge red flag. If it seems too good to be true, it is. What do you think about Madoff's story? Let me know in the comments. And if you found this video interesting, I'd really appreciate it if you like and subscribe for more videos like this.